This video will cover material in Chapter 8. Specifically, it'll cover a covered call and a protective put. These sometimes are called combination strategies because it uses a combination of the option and the underlying stock. And let's start with a covered call first. A covered call means you own the stock in combination with a short call. So you have a stock and you're short a call. When we do a protective put, it'll be a stock that you own in your portfolio, and then you're going to be long a put. Okay? So you have a position in the stock, in the underlying stock, and in the case of a call, a covered call, it's the stock in the call, it's the stock in the put with a protective put. Let's just focus on a covered call. I'm going to just make up some terms. Assume the stock price is at $60 a share. Let's say the strike is at 60. So this option is at the money. We can see that already. And I'm going to say, let's say the call price is $3.50. And I'm simply going to make up a couple of scenarios for the stock price at expiration. Let's say, what happens when the stock goes to 50? Say $56.50, and let's say $70. Okay, so we're going to do this methodically, and we're going to look at the stock by itself, and then we're going to look at the payoff to the call, the premium on the call. The sum of those will be the option itself. I'll call it the option profit, because remember, with a covered call, I'll call it CC. A covered call equals just a call. Call profit will equal the payoff plus the premium from the option, collected from the option, since we shorted the option. So I got that big plus sign there to remind you it's plus. Okay, and so the covered call is the stock plus the option profit. And then here we're going to have, so this is the stock profit, this is the option profit, and then we're going to have the covered call overall. Okay. So let's go look at the first scenario, $50. When the stock trades at $50, since you bought it for $60, you just lost $10 a share by expiration. Now, the payoff, you got to remember now, we're short a call. We need to figure out what the payoff is. So you got to go back to your rules that I asked you to memorize. And this is one of the reasons I asked you to memorize it, so you know it, you have it handy. You recall that the payoff from holding. Now, holding a call is ST, the stock price at expiration, minus the K, if the stock price is greater than K, and it's zero otherwise. But since you've written a call, you collected the premium, you wrote the call, the payoff that the holder gets is exactly the opposite of what the short call, the person who wrote the call, is going to get for a profit. So you put a negative sign in. Remember, zero-sum game for options. Okay, so now the payoff here is going to be, let's look at the payoff here from the perspective of the holder at $50. Well, the holder, the person who's long the call, is never going to buy the option by exercising at 60 when they could go in the open market and buy it at 50. So it doesn't make any sense. This option's out of the money. The stock is falling in price, right? Which makes sense because calls are bullish. The holder wants the stock to go up, and here the stock went down. So it makes sense that the payoff is zero. Now we collected that premium of $3.50. And so the option, profit on the option itself, all by itself, is $3.50. The option, right here, this is what's called a naked option, right? The option all by itself. But when you combine it with the stock, the underlying stock, it's now called a covered call. And so the covered call, we lost 650. Okay. Now, let's look at what happens when it goes up to, the stock goes up to, is at 56.50. It's actually, it falls 350. So the stock falls 350, you lost 350. The payoff is still zero because the option's still out of the money. Stock price is still less than the strike here. We collected 350. So we did make 350 on the naked call, the call all by itself right there, 350. Now, with the covered call, which has the stock also involved here, we have a profit on the covered call of zero, meaning break-even point. Zero profit is a break-even point. Now, let's see what happens when the stock goes to 70. Well, we bought it at 60 right here. Bought it at 60, it's at 70, so we made $10 on the stock. The payoff now, the stock is in the option is in the money by $10 to the holder from the holder's perspective, but we shorted it, so put the negative sign here. So it's going to be minus 10. Okay, so you can just plug this number in, minus 70 minus 60, which is the strike right here, 60, gives you minus 10. We collected the 350, and so here we lost 650 on the option, the naked option itself, 650. Overall, on the covered call, we made 350. So what we want to do in a minute is we want to analyze this row. We want to look at this row. I'm going to graph this row. I'm going to graph this row, and I'm going to graph the covered call, the overall row, so that we can look at the risk and return trade-offs that are going on here. And so keep in mind what happens when you have a covered call, and you'll see this in the graph in a minute. When you have a covered call, it reduces your downside risk, doesn't eliminate it, reduces, and it puts a limit or a ceiling on your upside. So when the stock goes up, there's a cap on how far you can go up. There's a ceiling, and it won't go any higher. So let's take a look at what I'm talking about here now. Stock price at expiration. K is 60. Now, let's graph the stock by itself. The stock by itself, the profit on the stock looks like this. That's the stock alone. At 60, it breaks even. Zero profit on the stock alone. For every dollar you go up in the stock price at expiration, you make $1. Every dollar goes down, you lose $1. Slope of positive 1. Okay, that's the stock alone. That is the very first row of that table I produced a second ago. Okay, it's this row right here. Now, let's look at the payoff, or the profit to the option. Now let's look at the profit to the option, and before we even do the option, we know what a covered call, the graph of a covered call looks like. The profit looks something like this. Okay? That is an option all by itself, a written call option all by itself has a shape that looks like that, which means we have unlimited risk. Because this option is not covered. It's a naked option all by itself. Okay? And so it's a naked option. But when you put the naked option and you cover it with the stock, as we have here, it'll be a covered call position. So let's look at what happens with this covered call. Now we know that this kink has to be right here, has to be at 60, and we know the height of this has to be 350 because that's what we sold the option for. So I'm going to come up here, kink right here, and it'll come down. That's the call alone, and this will be 350. Now, what we want to do is, so this is the call alone. I'll just call it a C for now. Now what we want to do is we want to put in add these two lines up, and we will have a covered call position. So to reiterate from the table, I graphed this first, the stock. Now I just graphed the profit to the option itself right here. Now I want to do the sum of them. And the sum of them, remember I told you, you can get the shape of this by looking at a slope of 0 plus a slope of positive 1, which means I'll do a little bit of work down below, that it's got to be an upward slope of 1 below 60. It's got to be an upward slope of 1. And then, look what happens. This positive slope of 1, this slope of negative 1 here, they cancel. So 1 plus a negative 1 means it's flatlining. Okay? So what's happening is it's got to look like this. I want to make sure I get this. I want to make sure I get this right geographically. It's hard. Okay, so the dotted line is the covered call strategy, the dotted line. And so notice what happens. We've reduced losses on the downside, so when the stock goes below 60 and you start losing on the stock, you don't lose all of this in this thick line. You lose only the dotted. You actually gain 350. That's what this difference is, 350 here, because you collected the premium. So it's the loss on the stock offset by the gain on the call, means that you've only lost a little bit of money, not as much. And then what you see over here is you have two positions completely offsetting each other. And the most you can make, no matter what the stock does, if the stock goes all the way up to $1,000 a share, the most you're going to make is $350, because these two lines are going to completely offset each other. This goes up, this keeps going down, and they offset. So what you've done with a cover call is you've collected this $3.50 premium, and what it did was, what did you get for that $350? You got a little bit of reduced downside, right? So you got that reduced downside. But to do that, you've given up all your upside potential. You've given it all up because you've capped it. You put a ceiling on it. So that is a covered call strategy. Now, let's look at a protective put. Sometimes called portfolio insurance, and it'll be obvious why it's called portfolio insurance, because what happens is you own a stock or a portfolio of stocks, and you're going to also go long, in other words, buy a put option. Okay? Now, let me give you an example. Let's say the stock price is at 40, X is at 35, and the put is at $2 a share. Okay. Now, take a look at this option. This option is out of the money by $5 at the moment. Why would you ever want to sell the stock at 35 with that put when the stock trades at 40 in the open market? So this is out of the money. You wouldn't want to exercise it now. It wouldn't make any sense to sell it for 35 when you could sell it in the open market for 40. So let's look at the payoff now. The payoff from holding a put is K minus ST if the stock price is less than K. Okay? And the payoff is 0 otherwise. And the profit on a put equals the payoff, this right here, the payoff, minus the premium paid. Because you're buying a put, so it's the negative sign here. So let's run the scenarios and see what happens. Let's see if it really does protect your portfolio. And so when you hear protective put or portfolio insurance, what you should see is you should see a floor, a limit on the downside. So that's where your protection's coming in. Limit on the downside with, in this case, unlimited upside potential. So that's what makes it attractive. It puts a floor on it, but you get unlimited upside potential, but it's slightly reduced compared to if you just own the stock itself. Let's run the scenarios. Let's say 30, 42, 55. Just made the numbers up. Stock, payoff from the option, the premium, the option itself's profit, and then the protective put. Okay. Now, you bought the stock, you own the stock when it's at 40, but now it's at 30, so you lost $10 on the stock. Okay. Now, let's see what happens with the payoff. Well, when the stock price is less than the strike, which it is now at 30, because it's at 30, stock price is 30, which is less than 35, right? The option is in the money by $5 at this point. So it's going to be 35 minus stock price at 30. So the option's in the money by $5. You paid a $2 premium, sunk cost. So you made $3 on the option itself. Basically, call it a naked put if you want. Usually it's not the terminology used in the world, but it is in a sense a naked put because it's a put. Right here is the put all by itself. Add the stock to the scenario, to the picture, and then you have a protective put. And in this case, we lost $7. Okay? Now, at 42, right? We bought the stock at 40. The stock's at 42. We make $2 on the stock. Now the payoff on the option is going to be, let's see, the payoff on the option. Stock's at 42. The 42 is greater than the 35. I should be making, by the way, I may have made this mistake a little bit earlier. I will forever mix up K and X. This is really K. That's the stock, the strike. Many other texts will use X, and I'm very used to X, but I'll use K here. I'll fix that. Okay, so let's get back on track. At $42, you make $2 on the stock. The payoff is going to be 0. The option's out of the money, which is normal. You know, you expect when the stock goes up, the option the put option tends to be out of the money. So that's what happens. We lost $2 on the put itself. And then overall, we break even at 42. Okay. Now at 55, we're going to make 15 on the stock itself. The option's still out of the money. We paid $2 as a sunk cost, and we made 13 overall. Okay. Now, this is portfolio insurance. So ask yourself, does this make sense? And why did you put this protective put on? You wanted to protect the value of your stock. And when the stock drops and you lose money and you're going in this direction and you're losing money, the option better pay off. And look what it is. It is paying off. It's starting to pay off as the stock drops. Here's that $5. It offset that $10 loss, right? It offset total $3. Now, what happens? You can see what happens here. What happens if the stock goes to 0? Well, if the stock goes to 0, you lost $40 on the stock itself. The payoff is going to be 35 minus 0. 35 minus 0. So that'll be 35. The payoff is still $2. You made 33 on the option itself. And so the most you lose is $7. So you can see you insured your portfolio. Losing 7 certainly better than losing 40. So what I'm going to do now is we're going to graph it. So we've got a visualization of the stock profit, the option profit, and the overall protective put. So we'll be able to see the risk and return profile of these visually. Okay. Now, let's do the stock by itself. So this is the K here. K is 40. Let's put these numbers in a little cheat sheet up here. S equaled 40, K equals 35, and the put was $2. So this is at 35, and the stock we bought was at 40. So the stock by itself, slope of 1, has a profit that looks like that. Breaks even at 40. Now, when you purchase a put, remember what's burned into your memory? What's burned into your memory is the shape of the hockey sticks for a protective put. It looks something like that. So you got to impose this shape on this graph. And you know it's going to kink at K. And you know it's got to cross this line. In order for there to be break even for the option itself, break even for protective put overall, it's going to have to cross this line. So what we have is we're going to have this for the protective put. Right here will be -2, the value of the put that we paid. Okay, so this is the put by itself, the put alone or naked. Okay, as you can see, when the stock drops, the put pays off. Okay, so that is the profit on the protective put, and the put by itself breaks even right there. Okay, now let's do the overall protective put. So remember what we have to do is, I'll draw a little bit down below here. This is a slope of -1, slope of +1. You add the two slopes. You know when the stock price is less than a strike, it's flat lined. And then you have a slope of 0 and a slope of +1 adds up to a slope of +1. So this overall has to look like this shape. So let's put this shape on this graph. And you're going to see it's going to look something like this. And I'll call it PP for protective put. This will be -7, and it corresponds to this last row, -7. Breaks even at 42, and then at 55 you'll have a $13 profit. So here we lose $7, all of here fixed. That's our floor on how much we can lose. So even if the stock goes to 0, like I showed you earlier, if the stock goes to 0, we're going to lose 7, right? Because the stock by itself continued down. The stock would lose 40. We'd lose 40 on the stock, but we'd make 35 on the option itself. It would net out to be we'd make 33. The payoff would be 35 on this option, but we paid a $2 premium, and so the net effect would be we would lose $7 right here. Okay, now let's take a look closely at a price of 42. If this is 42, where it breaks even, the overall protective put breaks even, and that's a profit of 0. And so at that point, we make $2 on the stock by itself. This is $2, and we lost $2 on the stock. Breaks even to 0. If we go to 55, it's hard to draw, but 55 overall, this would be $13 right here, because the stock would have made 15. We would have lost 2 on the option. Would net to 13. And so here you have it. I'll draw it nice and thick, a protective put. So notice the floor on the downside and the unlimited potential on the upside, which is what makes protective puts extremely attractive in the world of finance. It's been around quite a long time. You can do it in StockTrack quite easily. I'll give you a quick example. If you buy $100,000 worth of spiders, SPYs, and you buy it on the stock pit. Okay, you're long the stock. You're basically long an index, And what you could do is you can go to the Chicago Board of Options Exchange and look at the prices, and you can go straight through StockTrack in the options pit. I call it the options pit there, where you can trade the options, and you go and you buy spider puts, and that's all you have to do. Buy the stock, an exchange traded fund, SPY. You'll get the action on all 500 stocks. You'll buy the options which trade against the stock, right? So you buy the puts, and you will have a result that looks like this at expiration.